On the morning oil surged past $140 a barrel, the sell orders were already queued. Not in public, not in headlines. Inside risk committees, inside energy desks, inside institutions that had been adjusting exposure for days. By the time markets crashed, the decision had already been made. What happened during the Iran escalation and what happened to millions of investors who watched their portfolios drop over the next several weeks is not the version you are being shown in headlines. The official narrative says oil spiked because of geopolitical tension. Markets reacted emotionally, and volatility followed naturally. A chain reaction, an unfortunate but unpredictable series of events. The documented record shows something more structured. This is the first video in a series examining the Iran escalation and the market reaction that followed. Today we are examining the first phase, the oil spike and the equity crash, specifically what institutions were doing before the broader market understood what was happening. In part 2, we will examine positioning shifts inside major banks and hedge funds. In part 3, we will examine the policy response and its long-term consequences. By the end of this video, you will understand exactly why energy markets moved first, why equity markets followed, and why the people responsible for managing institutional capital had already reduced exposure before the public narrative shifted. Let's start with the oil market. When tensions escalate around Iran, the first market to respond is not equities, it is crude futures. Roughly 20% of the world's petroleum supply passes through the Strait of Hormuz. Any credible threat to shipping lanes forces immediate repricing in Brent and WTI contracts, not because of panic, because of math. Before the first major headline about escalation hit mainstream outlets, shipping insurance premiums in the Gulf had begun widening. Options volatility in crude futures was climbing. Energy derivatives desks were pricing increased tail risk. These adjustments were visible in the data. Equity indices, however, remained elevated. That divergence is not new. It appears before nearly every energy-driven market stress event in modern history. In 1973, crude prices surged sharply before the broader economic contraction materialized. In 1990, oil spiked immediately following Iraq's invasion of Kuwait, while equity markets lagged in fully pricing the geopolitical shift. In early 2022, energy markets repriced supply risk weeks before major equity indices reflected the scale of global disruption. Energy markets respond to physical constraints. Equity markets respond to narrative and earnings revisions. That difference matters. By the time oil was climbing steadily during the Iran escalation, institutional models had already begun adjusting. Large asset managers run cross-asset risk systems. When oil volatility expands, those models incorporate the impact on inflation expectations, corporate margins, and monetary policy constraints. Higher oil implies higher transportation costs. Higher transportation costs compress margins. Margin compression alters forward earnings expectations. If inflation persists because of energy, central banks cannot ease policy aggressively. Discount rates remain elevated. This is not speculative reasoning. It is embedded in valuation frameworks. When oil crosses certain thresholds, equity exposure is reduced automatically in many systematic strategies. The public did not see a panic. They saw markets drift lower and then drop sharply once headlines intensified. Inside institutions, exposure had already been trimmed. Consider the sequence. Oil futures began trending higher over several sessions as geopolitical risk built. Volatility in energy options expanded. Commodity-focused hedge funds increased long exposure. At the same time, multi-asset portfolios began hedging through index puts and volatility instruments. By the time missile exchanges were confirmed and maritime security warnings were issued, the repricing had already begun. Equities fell sharply in the days that followed. Commentators described it as sudden. It was not. Let's examine institutional incentives. Financial institutions are designed to preserve stability publicly while managing risk privately. If a major bank issued a research note stating that escalating tensions with Iran could trigger cross-market liquidity stress and force deleveraging, that note would itself amplify volatility. Confidence is an asset, so risk management is executed quietly. This pattern is visible historically. Before the 2008 financial crisis, internal risk assessments at major banks documented deteriorating mortgage quality months before public acknowledgement. Certain trading desks were hedging subprime exposure while marketing structured products externally. Congressional investigations later revealed internal emails reflecting awareness of systemic fragility. The same structural dynamic applies to energy-driven shocks. When oil spiked sharply, Institutions do not wait for television panels to debate implications. They adjust. Margin requirements on futures contracts increase. Value at risk models force position reductions. Leverage strategies shrink exposure. Pension funds rebalance allocations between equities and commodities. The visible crash is often the final phase of a prior adjustment. Now consider Iran specifically. Iran's geopolitical position is not symbolic, it is logistical. Its proximity to critical energy transit routes creates asymmetrical risk. Even the possibility of disruption forces insurers, shipping firms, and refiners to reevaluate exposure. Markets do not price certainty. They price probability-weighted risk. When probability increases, even slightly, price responds. This is why oil spikes are rarely isolated events. They ripple. As oil climbed during the escalation, bond markets began reflecting higher inflation risk. Break-even inflation rates widened. Real yields adjusted. Currency markets shifted. Equities were slower. Why? Because equities often anchor to earnings guidance and quarterly reporting cycles. Energy traders operate on physical shipment timelines measured in days. The lag creates opportunity and vulnerability. Institutional operators watch energy markets as leading indicators for systemic stress. Retail investors often watch equity charts. This difference in focus creates asymmetry. When oil volatility reached levels inconsistent with stable equity valuations, de-risking accelerated. Systematic funds reduced gross exposure. Risk parity strategies rebalanced. Option markets priced wider downside protection. The crash phase that followed was not primarily emotional selling, it was mechanical deleveraging. This pattern repeats across crises. In 1979, during the Iranian Revolution, crude prices surged dramatically before the broader economic impact became visible. Inflation accelerated, policy tightened, equities adjusted later. In 1990, oil spiked sharply ahead of a recession triggered partly by energy cost shocks. Markets initially underestimated the persistence of elevated oil prices. In 2022, crude moved aggressively as geopolitical risk intensified, preceding significant repricing across global equities. The energy market is upstream of everything. If oil remains elevated, it constrains policy flexibility. If policy flexibility is constrained while valuations are stretched, fragility increases. This does not guarantee collapse. It increases sensitivity. The critical insight is not that institutions possess secret knowledge. It is that they respond to risk differently. An institutional risk committee evaluates worst-case scenarios continuously. If oil remains above a certain threshold for a sustained period, what is the impact on earnings, on credit spreads, on funding costs? If those scenarios threaten capital preservation, exposure is reduced preemptively. Retail investors often wait for confirmation. Confirmation is expensive. The narrative presented publicly emphasizes unpredictability. It frames the market reaction as shock. But oil did not spike randomly. It responded to measurable escalation risk, and institutions did not react randomly. They followed risk frameworks. The phrase "they knew" does not imply omniscience. It implies structural awareness. They knew that sustained oil volatility above specific levels destabilizes leveraged equity positioning. They knew that elevated energy prices feed directly into inflation expectations, limiting central bank responses. They knew that markets priced for stability cannot absorb prolonged energy shocks without adjustment, so they adjusted. By the time markets fell sharply, exposure had already been recalibrated in many large portfolios. This is not conspiracy. It is process. Financial systems are built on leverage and trust. Energy shocks test both. When leverage is high and policy flexibility is limited, shocks transmit faster. The lesson is not to predict geopolitical events. It is to monitor leading stress indicators. Oil versus real yields. Oil versus equity volatility. Oil versus credit spreads. When these relationships diverge, fragility increases. In the weeks surrounding the Iran escalation, oil volatility expanded first. Credit spreads widened modestly. Equity volatility followed. The sequence was observable. Markets did not crash because of a single headline. They repriced because structural stress met catalyst. Energy markets signaled the stress early. Institutions responded. The public reacted later. The final point is structural. Institutions have incentives that differ from individual investors. They are tasked with avoiding catastrophic downside. They operate within risk limits. They reduce exposure when probability-weighted outcomes deteriorate. Public messaging, however, emphasizes resilience. This divergence is not moral failure. It is institutional design. Oil spiked. Markets crashed. They knew that the combination of elevated energy costs, constrained monetary policy, and leveraged valuations was unstable. And once you understand that structure, you stop looking for surprise. You start watching sequence. Because in modern markets, sequence determines survival.